Okay, good morning, good evening, good afternoon, guys. So today we'll be solving the 2016 accounts paper 2, which is 2 hours. So let's jump into it straight. So the first question says, mention the source document used to write up the following subsidiary books. So we have the first one, which is the sales day book, and the next one is the returns inwards book, the purchases day book, the returns outwards day book. So these are books of prime entry, and these are just some of them. There's even the cash book, there's the petty cash book, and there's the general journal. So all these are actually books of prime entry you're actually supposed to know at grade 12 level. Yeah. So the sales day book, this is a book of original entry in which we record transaction where customers get goods on credit from the business. And the source document for the sales day book is actually the duplicate invoice or the sales invoice. You actually pick any of that. So you just say sales invoice or duplicate invoice. Then the returns inwards day book. This is a book now in which the customers that bought goods on credit from our business are now actually returning them back, maybe due to wrong color, oversized, or maybe I undercharged them. Yeah. And the source document for actually the returns inwards book is actually the duplicate credit note. Don't forget that. I'll repeat it again. Duplicate credit note. Then the purchases day book. Now the purchases day book, in this book now, it's where we record goods actually bought on credit from suppliers for resale. So this one, the source document for the purchases day book, is actually you can go for the original invoice, the purchases invoice, or incoming invoice, either any of the three. So I'll write it original invoice or the purchases invoice. Then now we go to the returns outwards day book. So the returns outwards day book, now this is whereby we've bought goods on credit from the supplier, but now you find that we're actually returning them back to the supplier, maybe due to the fact that they gave us the goods that were of wrong color, or maybe they were just, maybe the size was not actually the right size, or the amount that they've given us was not actually the right amount of goods that we're actually expecting. And actually the source document for the returns outwards day book is the original credit note or the purchases credit note. So you just write original credit note. Original credit note. Then we go to B of question 1, which reads, classify the transactions below according to capital expenditure, revenue expenditure, revenue receipt, and then capital receipt. Now what you have to know about the capital expenditure and the revenue receipts. So for the first ones, you're noticing that they're having expenditure for both the capital and the revenue. Then the other one, they're having receipts for both the capital and the capital and the revenue. So what you have to keep in mind is that for expenditure, this is money actually spending, to actually obtain something or get something. Then for the receipt, keep in mind that this is now money that you are receiving. Yeah, so you should try to classify them in that way. Expenditure, you're spending them on something. Receipt, you're receiving. So now the first question reads, import duty paid on delivery of office computer bought for business use. So now this is actually capital expenditure. Why do I say capital expenditure? Because capital expenditure is actually money used to obtain a fixed asset. That's actually just saying classify the transactions below according to capital expenditure, revenue expenditure, revenue receipt, capital receipt. So the first one says import duty paid on delivery of office computer bought for business use. So this one, like I said, it's actually capital expenditure, and I said that the expenditures treat them that you're spending money on something, or spending money to obtain something. Then the receipts, you're receiving money either maybe from selling a fixed asset or just on the day-to-day running of a business. Maybe you sell some certain goods and you receive money. Yeah. So this one was saying that import duty paid. So when you hear just the word paid, just know that it's one of the expenditures, either revenue expenditure or capital expenditure. So now this one is paid on delivery of office computer. So there's actually a fixed asset here. So you just already know that this is something to do with capital expenditure. Then the next one is actually sale of old furniture by check. So like for the receipts, um, the capital receipt it is whereby you capital receipt is whereby you receive money on the sale of a fixed asset, or maybe you receive money maybe by obtaining a loan. So that's why you should try to refer to the capital receipts. Whereas the revenue receipt, this is actually whereby you receive money maybe on the certain goods that you're selling from your business, money that you're actually receiving that's coming in. It can be commission. Yeah. So we actually go to now to this one, which was saying sale of old furniture by check. So this one, you're receiving money simply because you've sold a fixed asset. So this one is going to be capital receipt. Then the next one is payment of interest on a loan obtained for extension of the factory premises. So I forgot to actually mention as well that the capital expenditure can also be used to spend money on the extension of a fixed asset. So this is why this one is actually capital expenditure. Then the next one is commission received for work done on behalf of another person. This is revenue receipt. I already explained on that. And legal cost for buying a new factory building. This is capital expenditure. You already know. Then the interesting one now. This one is actually a trial balance with additional information. So it reads, S. Musongo is a sole trader and the following transaction were extracted from his business. So these are the transaction. Just to not beat too much time, I'm actually just going to let you just look at the same transaction. So these are all the transactions that are there. Then it was the given transactions took place after the extraction of the above trial balance. So you find that this person has actually prepared his trial balance. It's actually balanced, but now there's actually some more information, some more details that have actually taken place, and he has to include them in his trial balance. And these are saying that on the 31st of December he bought goods by check, which were 90 kwacha. Again, he also bought goods on credit, 500 kwacha. He sold goods by check, 700 kwacha, paid cash for repairs, 50 kwacha, cash sales, which were 250 kwacha, and he received a check from S. Zimba, a debtor, which was 520. Then we're required to prepare another trial balance, after taking the above transaction into consideration. So for this one, what I'm actually going to do, I'm actually going to prepare first accounts. I'm going to prepare first some accounts for this thing, for these transactions that were taking place. So I'm actually going to open up mini accounts, and from there I'll take the balances that I've gotten from those accounts and actually put them in the trial balance. So this is actually what I mean. The first one is saying that he bought goods by check. So what's going to happen is actually this. I'll open my first account. This is what I mean by mini accounts. So you just write details: debit, credit. In here it should have been maybe a folio. So this is the way it's going to be. So bought goods by check. So when you buy something, simply means you're purchasing. So the first account to take into consideration is that there's purchases accounts here because of the word bought goods. So just hearing that same word bought goods, meaning that there's a purchases account. The next one is check. There's a check being involved, meaning there is a bank account. So there are actually two accounts being involved here. So let me open another one, another mini account. one's debit, credit, and details. So we start now. So bought goods by check, like I've said, that two accounts being related here. There's the purchases, bought goods by check, so this is purchases account, and there's bank account. So we need now the balances from the trial balance that you prepared first. Those are the balances we're going to start with. Our opening balances are going to come from the trial balance that this person already prepared, that balance. And the balances were, if we take a close look, for our bank, the balance was, here it is, the balance was 1,620. So I'm going to go in my bank account and just write balance, which is 1,000. Oh, and look at this. There's, on the trial balance, there's actually a debit side and a credit side, and we already know that bank, just the normal balance for bank is actually supposed to be debit, but in this case we're finding that it's at the credit side, so meaning this is actually an overdraft, meaning, yeah, so we're actually going to get it, to get the way it is, the 1,620, and actually put it at the credit side, 1,620. Just know that this is actually an overdraft. Then we go on now to our purchases. What's the balance for the purchases as well? For the purchases, the balance is 6,860. So this one is actually at the debit side, 6,860, which is balance. And this should be balance carried down. Balance carried down. Then now we go on to the transactions. What was it actually saying? It's saying that this person has bought goods by check, which are 90 watts. So what you're actually going to do in the purchases account, you write check, or if you want you can write bank, but I'll go with check. And then in the bank account you write purchases. So this person bought goods by check, which are 90 watts. When you've bought something, you've obtained it, it's now yours. So meaning this thing is actually coming to us. There's this saying that what do we call it, the golden rule in account, which states that debit the receiver, credit the giver. So meaning we have received goods simply by buying when we've purchased. So when we say bought goods by check, so the purchases account is gaining. You've received, the purchases account in simple has received. So in the purchases account, this balance of 90 kwacha, I'm going to, what's this, debit it. Then when I go, simply what's happening here is what we call the what name can I use? Wait just a bit. What the thing that we're actually going to use here is actually the double entry rule. That's what's actually happening. So you find that there's actually this one statement that's taking place here, and it's actually affecting two accounts. So this is what we're actually referring to as the double entry rule. So you find that the same transaction will actually be involved in the purchases account and will actually be involved in the bank account. So like I've said that this person has bought goods by check, so meaning the purchases account has actually gained and I've debited the 90 kwacha. And in the bank account, you already know that this person has taken money out of his bank and actually to go buy goods. What's going to happen to the bank account? It will decrease. So simply, this is why we're actually going to say 90 kwacha will be credited. Yeah, so that's it on the first transaction and the two accounts that have been opened. Then we head on to the next one. The next one reads bought goods on credit. So there's another account that has to be prepared, but the other one will maintain as the purchases account, or it is just like I bought goods. And the next one will open a credit account. So here there will be details. This is actually the credit account. Details, debit, credit, and failure. So what's the normal balance for the credit? We head on to the trade balance. Yeah, then the normal balance of this one is actually where is it? Do we have credit here? We don't have credit, so meaning this one doesn't have an opening balance. so it doesn't have an opening balance. So we'll just head on direct into going go additional information and saying what it's actually saying, which is bought goods on credit 500 quarter. So we said we're following the double entry rule. So this 500 is actually affecting two accounts. So what's happening here? He's bought goods, so meaning the purchases account is gaining. It's gaining. It's actually increasing in simple. So meaning the 500 in the purchases account will be debited. So write credit here. Then in here we'll write purchases in the credit account. So we say that this one will be credited. In this one we'll have a decrease simply because he's removed money on credit to just go buy goods. So this one will have a credit account. And keep in mind that on the dual aspect rule or the double entry rule is that when one account maybe has been debited, just know that the other account has to be credited. I don't think there's actually a scenario whereby both accounts are actually having debits due to like the way the transactions are being taken place here. It's either one account is when one account is affected by debit, the other account is going to be affected with credit. So the third one now, we said sold goods by check. So this one again, there's another account that has to be prepared, which is when you're selling, he's selling goods, so the account that's going to be opened obviously is the sales account. So I open another account, which is the sales account. So I'm actually taking my time to actually explain to you just the way it's actually done, but you can actually go through and practice, and you'll find that you'll actually be way faster than this, because accounts, it's just 2 hours and you're supposed to be working with time. So I would prefer you practice this on almost a daily basis, because otherwise, yeah, so I prefer you actually be practicing this. Is actually the sales account. To check if the sales is actually a normal balance. Sales, do we have a normal balance? Yes, we do. The sales normal balance is 13,400. So let me just do this, but again no. So I'll write balance, which is, so let's look, is it at the credit side or debit side? It's at the credit side. So the sales is 18,400, the normal balance of it. Then when we come here, it's saying that sold goods by check, which is 700. So meaning when you sell goods by check, when you sell, you find that your bank account will be increasing. Why? When you've sold, money is actually coming in, and we're saying that he's selling by check, so meaning money is going direct into his bank account. So meaning here on the bank account I'll write sales, and then I'll write how much is it, 700. Money has gone direct into his account because he sold goods and money has gone inside the account. Then when I come here, I'll write bank. So meaning if this one had an effect of debit, of course this one's going to have an effect of credit. He sold. Then we go to the next one. The next one said paid cash for repairs. So meaning here there's actually another account, two accounts, which is the cash account and the repairs account. So details, debit, credit, details, debit, credit. So for this other one, we say that paid cash for repairs. So there's actually going to be a cash account, paid cash, cash account, and the repairs account, repairs account. So we start. Do we have a balance of we check if in the trial balance, the first trial balance, if there's actually a balance for the cash. Yeah, there was actually a balance for the cash, which is 120. So meaning what will actually happen, I'll write balance here. And is it at the debit side or credit side? It's actually at the debit side. So this is 120. Then I'll go to my repairs account and I'll say balance. Do we have any repairs account in here? We don't, so it doesn't have an opening balance. Then I'll head on to the what the transaction was saying paid cash for repairs, which is 500. He's paid cash. So meaning in the cash account what's happening? It's actually going to be reducing simply because he's taken out cash to pay for repairs. So this is actually going to reduce it. So I'll write repairs in the cash account. How much is it? 50 kwacha, and I'll credit it. It's removed from his cash account just to go pay for the repairs. In the repairs account I'll write cash and I'll debit it. Then we head on to the other transaction, which is saying cash sales. So for this one I don't have to prepare any account simply because they are both there. The cash account is there, the sales account is there. Cash account is there, the sales account is there. So I'll say cash sales, which is 250. So cash then sales. So meaning what's actually happening is that the cash account is increasing because he's selling goods on cash. So meaning when he sells them, he's having more cash in his cash account. So meaning when you go to the cash account, we'll write sales. How much is it? It's actually 250. We debit it. Then we'll go in the cash, we'll go in the sales account and write cash, and we'll put 250 here and we'll debit it. Then we'll head on to the next one, which is saying received a check from S Zimba, a data. So this one we just have to prepare one account, which is S Zimba, an account for a data. That's it. But for the other one, it's written check. We already have a bank account here, so just the final account. Okay, let's hope this will fit. So S Zimba, or if you want you can write data's account, but I prefer writing the person's name. S Zimba account. Then you write details, debit, credit, you write balance. So on the data, so this is like S Zimba. So you can just even just say this is actually a data's account, like I said. So you go in your trail balance to actually check if was there a balance for details. Yeah, there was actually a balance for debtors going at how much? This was going at 4,220. So it's just like debit side 4,220. That's the normal balance. We head on to what the actual information was saying. The actual information was saying that received a check from S Zimba, a data 520. So meaning in here I'm actually going to say check. He's received a check from S Zimba. So meaning in the debtor's account, it's actually going to decrease the amount. The balance was here, but this was the balance that this person is owing us, but you find that he's actually paid back. Debtors are actually people who are owing money to the business, but this one has paid back, which is so meaning there'll be a decrease in here, 520. And when he head down to the bank has received. So meaning you can write the person's name or you can write a date. Doesn't really matter. So you write 520 because the bank has received. Then just like that, we are done with our accounts. All the transactions here were actually affecting all these accounts here. So now we just balance them off, and then we'll open now the draw balance. Then from there, you will just see that it will actually balance off with having all the additional information in the same draw balance that we'll actually prepare. So you write down balance, carry it down, and bring it here. Then you write down balance, brought down. So you actually add up these. How much is that going to give you? I'm working. So yeah, then now all you just simply do is add these numbers up. So this is 60, 6860. Sorry, my calculator is a bit slow. 68, 6,860 plus 90 plus 500 which is giving me 74 or 7,415. 7,450. So here is like nothing. So what you will simply do is bring 7,450 right here. Then you bring it to a balance breakdown as 7,450. So now what actually makes you know like what you've actually done for this account is right is because the normal balance for purchases, just know that the normal balance for purchases have a debit balance, and if they've actually landed, the balance brought down has actually come to a debit side, and just know that what you've actually done is right. So it being at the debit side, the 7,450, meaning you're actually right. Then you head on to the bank. So for the bank, there's 700 plus 520, which is giving me, this is 1,220 for just the debit side. And when I head on to the credit side, this is 1,620 plus 90, which is giving me 1,710. So which one is actually the bigger one? So sorry, you said balance first, I forgot the balance. Balance carried down, bringing these lines like this. So they're going to say the bigger one is the one that's actually going to be here, 1,710, 1,710. And from there you subtract the bigger one from the smaller one, simply because we're looking for a number to come here. So here you also write down balance. We're looking for the balance, the balance carried down. So you will say the 1,710 minus the 1,220, the total of these two here, the ones at the debit side, because we already know that the one having the largest amount is the one at the credit side, the 1,710. This is why I brought them both here. And now I subtract simply because I want both of them to actually have the same balance. So I subtract the larger one from the smaller one. So 1,710 minus 1,220, which is giving me 490 right here, which will also come as the balance brought down, since it's here to come here 490. So just know that we actually have a bank overdraft, meaning even in our neutral balance we'll put 490. So we head on here to the purchase, to the credit account, we say balance carried down, and we say balance brought down. So here there's 500, 500. Then when here there is, so here there's like nothing at the debit side, but here we, so here we'll put 500, and then here we'll put 500 as one brought down. Then now we'll go on to the sales account, we'll say balance, and we'll draw this and this. Then we'll add up all the amounts. Here there is 13,400. Sorry, just a bit. Okay, seems like my calculator is a bit damaged. I guess I'll just do it the old way style. So there's 700 plus 250, 240, 0, 4, 7, and 900. So meaning 13,400 plus 9, 4, sorry, 13,400. So this is going to be 14,340. Okay, sorry, so this is going to be 14,340, 14,340, which is actually going to be here 14,340, 14,340. We head on to our cash account, say balance. Sorry about that. I forgot the folio. This is carried down in this stapling, balance, brought down. Sorry for this one. Okay, let's do this on balance. Carry down, balance, brought down. So here will be 15, 15, 50 here, we'll bring down the 50 here. Here, what was the total going to be? Was 120 plus 240. 120 plus 240. It's going to give me 360. Yeah, 360. Then 360 minus 360 minus 15. It's going to give me 310. So 310 is my balance for the cash, and it's going to be at the debit side, 310. When I come to the debtors, which is balance, so here I'm going to have a balance of 4,220. 4,220. So 4,220 minus 520. That's going to be that's going to be 3,700. Yeah. Okay, so once we have all this, next what's going to actually come is we now start filling in our details into the trial balance, the one that we're actually now going to create the new trial balance. So now we draw up this. So this is going to be the date column, details, debit, credit. So now we'll be getting information from our previous trial balance and also including it here, plus the additional one that we've actually made. So now we'll start. The first thing we actually have is capital. And the capital is going at 4,480. So I'll write capital. And it was at the credit side, 4,480. Then we have salaries. Salaries are going at 3,540. Salaries 3,540. Then we have debtors. For debtors, we're not going to get this amount that's in the previous what's his trial balance. We're going to get this amount, one with the adjustments, one which is brought down, and which is going at 3,700. 3,700. So 3,700 for the debtors. Then we go also for purchases. Purchases as well, we'll get the one in the additional information. How much is it? The one brought down. This is 7,450. Purchases 7,450. Then we go on to sales. So all this information I'm actually getting them from the previous trial balance. Yeah. So the sales also had some adjustments. This was carried down. This was brought down. So we get the one that's brought down, which is 14,350. 14,350. Then we head on to the drawings. The drawings never had adjustments, so we get the one from the previous trial balance, which is 1,920. 1,920. Then we also get bank. Bank had some adjustments. If you can remember, when the balance for brought down for bank is 490 at the credit side. 490. It's an overdraft, in fact. Then we go on to cash. Cash also had some adjustments. Cash is going at 500 at the credit side as well. Sorry, I just made a mistake. This was actually credit. I got the credit one, so this is actually not supposed to be here. The cash one is actually here. The cash was here, but the brought down is actually 310. So it's going to be 310 at the debit side. Then we go on to stock. So the stock amount, the balance is actually 1,680. 1,680. Then we go on to building. Building never also had some adjustments. Building is going at 720. Then we go on to sundry expenses as the last one, which is going at 440. Sundry expenses is going at 440. Then the next one now, we put in the purchases account, we put in the bank account, we put in the sales account, we put in the cash account. But we've got some accounts, under the additional information that were not included on our previous trial balance here, which is the credit account. If we check here, we absolutely do not have credit here at all. We find that in the additional information there was a credit account that was being involved, meaning we're actually going to involve it under our trial balance. So credit, and the credit account is going at 500. So I say 500. Then the next one is actually the repairs account as well, was not there. Repairs account going at how much? 50. Then even the what else? I think that's it. Yeah, I think these are all the accounts now. Then we add up the total to balance it off. Balance. We see if it does actually balance or not. So we start it. That's the big guys. My calculator seems to be having some issues. I don't know why. I don't know if it's dust or what, but okay, just wait a bit. It seems to not be functioning well. I don't know why. Oh yeah, sorry guys, made a mistake. For the credit balance, I put it actually at the debit side, when in actual sense it has to be the credit side, 500. In the repairs, yes, repairs are actually expenses, so they'll actually come at the debit side. So now we add up the totals. We've got 3,540 plus 3,700 plus 7,450 plus 19,020 plus 310 plus 1,680 plus 720 plus 440 plus 50, which is giving me 19,810 at the debit side. Then we go on to the credit side. We've got 4,480 plus 1,400, no, 14,350 plus 490 plus 500, giving me 19,020. Somehow wrong. It's something that's, I don't know, that's not right. Yeah, I was just checking, but there was somehow we were wrong right here. I'm getting the sales figure. I actually got it as 14,350, but in actual sense it's 14,340. So here was an error, 14,340. Now if I add that up, 4,480 plus 14,340 plus 490 plus 500, which makes it balance 19,810. So that's how it's done actually, guys, for the trial balance at least. Then we head on to the next one. There's also a book of prime entry, which is the sales day book. The question actually reads, from the following transaction, you are required to write up the sales day book. January 1st, 2014, sold the following on credit to M. Simwamba. 30 boxes of Boom at 200 per box, 20 boxes of Chic soap at 100 per box, less 20% trade discount. Then on January 15, 2014, he sold goods on credit to Chiwata with 7,000, less 10% trade discount. January 28, 2014, Movita bought goods on credit from Muvala with 3,000 net. So we start. And so this is the date column, details. This is the invoice number. Sorry for that. And then here is supposed to be the invoice number. Here it's supposed to be total amount. Then here it's supposed to be invoice amount. Let me start. On January 1st, 2014, we sold goods to, in fact, forgot the title. I also forgot the title for the trial balance. So the title is actually going to be S Musungu's trial balance as at 31st December 2014. That's the title. Then we go here. This one is going to be Muala's sales daybook. So it's that. So on 1st January 2014, he sold goods to MC Mwava. You just underline that, then you write down the goods this person actually bought from Muvala. So he actually got 30 boxes of Boom. That's 200 per box. So how much is that? 30. Since it's 30 boxes of Boom, it's 200 per box. So meaning you're actually going to multiply 30 times 200 because it's per box. So 30 times 200, which is going to be 6,000. I'll put it in the invoice amount, not in the total amount, because there are other goods that this person has actually bought. So 6,000. Then I go on to the other goods that this person got. He got 20 boxes again. 20 boxes of chick soap at 100 per box. So this person has actually gotten 20 boxes of chick soap at 100 per box. So we're going to do 20 times 100. That's going to be 2,000. So that's going to be 2,000. But there's also a trade discount there. So what's going to happen? I'm actually going to do this. Wait just a bit. 20 bucks per box, less 20% trade discount. So this is actually 2,000. And I'm actually going to adapt these guys. 2,000 plus 6,000, which is giving me 8,000. So now the trade discount of 20% of 8,000, that's going to be 1,600. So you actually subtract the 20% discount. So how you actually find the 1,600 is like this. What you actually do is say the total, which was 8,000, and I added the 6,000 plus 2,000. How I got the 2,000 was actually simply just add 20 times 100. And now I got the 6,000 was 30 times 200. So I mean this. So now how I'm going to actually get the 1600, which is the 20% trade discount, is say 8000 times 20 divided by 100, which is giving me 1600, which I've put here. Then I'm actually going to subtract the total amount, which was 8000, the goods I got, plus minus the discount that they have given us. It's 8000 minus 1600. It's going to give me 6400. I put it on the total amount for Msimwab, the goods that he's gotten on this January 2014 with 6400. And we go on to the next one, which is January. No, this is actually supposed to be 15. On the 15th of January 2014. Credit name. Sold goods on credit to Chivata. So I'm just going to say goods 7,000. Goods sold, which is 7,000. So Chivata goods sold to him with 7,000. Then there's also a discount. Sorry, I forgot here. You're actually supposed to actually even say trade discount, just to show that the trade discount is actually for 1600. So even here, trade discount. So how you're going to get the discount? Same thing. This is 10%. So you're going to say 7,000 times 10 divided by 100. It's giving me 700. So 700 here. Then you subtract 7,000 minus 700, which is giving me 6,300. Sorry, this one's actually supposed to go total amount. Then we go on to 28th of January 2015. Movita bought goods on credit. So now we write down his name, Movita. He bought goods on credit. Goods on credit. With how much? So this one we just put it direct because he was only getting goods that are worth 3,000 and nothing else, no trade discount, no other goods gotten. Then from there we go on to the last month, the last day of January 2014. Then we say transfer to sales count. And we add on the total. We add on the 6,400 plus 6,300 plus the 3,000 is going to give us 15,700. That's our total balance. And just like that, that's how you actually deal with the sales day book. Then we head on to question 2. For that, this is question 2. Yeah, so now you add up both sides, the debit side and the credit side. So we've got 340 plus 7,450 plus 1920 plus 310 1,680 720 plus 440 plus 50. So now question 2 reads, mention any two types of ledgers. So the two types of ledgers. So the types of ledgers that are actually there, you're going to have the general ledger, which is also known as nominal ledger. You're going to have the sales ledger, and then you're also going to have the sales. I've said already the sales ledger. Then you're going to have also the purchases ledger. So these are the ones: general ledger, sales ledger, purchases ledger. These are the ledgers you actually have, and you can pick any from that. So I'll actually go with the sales ledger, purchases ledger. Yeah, any of the two. Then they'll give you the marks. Then list two classes of ledger accounts. So the classes of accounts, they are actually referring to the real account, nominal account, and personal account. So they just want me to list them. So I'm actually going to go with the real account and the nominal account. These are the classes. Then we head on to this one, B, which says Musaka was a customer for Chipo. From the following details, prepare Chipo's account in Musaka's ledger for the month of October 2013 and balance of the account at the end. So let's start. So we're going to have debt, details, debit, credit, folio. Then I'm going to write Chipo's account. So this one, Musaka was a customer for Chipo. So Chipo is like the supplier. So this is also known as a creditor's account. You can simply go for purchases ledger. Then we start balance. Balance due to Chipo was 600. So I went to put 600 at the credit side. This was actually happening in 2013. Actually, we put 2013 October 1. This was the balance. In October 8, Musaka bought goods with the list price of 1,000. So purchases. He's bought goods, like I said, when you buy goods, you're simply purchasing. So he's bought goods with a list price of 1,000. Then from Chipo, less with a less 20% trade discount. So what's actually going to happen here, you're going to get the 20% of 1,000, and it's 20 divided by 100, which is 200. Then what you're actually going to do is subtract 200 or 1,000 minus 200. That's going to be your actual amount for the purchases that is actually bought, 800. Then Musaka retained some of the goods bought on 18th October for 200 list price. So this is actually purchases retained, which was taking place on October 17. Purchases retained. So Musaka retained some of the goods bought on the 18th October for 200 list price. So you're going to get 20% of 200 because he's actually retaining goods that he bought on the 18th. So he actually has to also retain them with the same discount that they gave him on the 18th. You're going to say 200 times 20. I need 20%, which is 40. So you're going to subtract 40 from 200, which is going to be 160. So the 160 will go at the debit side here. Then you go on the 20th. Musaka paid Chipo the amount due on 1st October, less to 1 over or half percent of cash discount to 2.5% of cash discount. So Musaka paid Chipo the amount that was due, which is the same 6,000. So here, what's actually going to put, if you want, you can put check, bank, but anyway, I didn't write the means of ways he paid, so I can actually put cash here. He's actually paid back. So to find the amount that is actually paying back, we need to find the percent of the 2.5% of 600, which is going to be 2.5, because that's half. So meaning it's going to be 2.5 times 600 divided by 100. So that's going to be 15. So you even write down discount put discount received. So the discount that's been given here for it's 15, 2.5 of 600, which is 15. Then we subtract to get the cash amount that is actually paid. 600 minus 15, which is going to be 585. Then from there we go on the 27th. What was taking place? Musaka bought goods from cheapo 300. Again, purchases 300. Then from there you balance it. So 600 plus 800 plus 300. This side we're having 1700. The other side we've got 160, 585 plus 15 is going to give me 760. So you can already tell the biggest one is 1700, 1700. This is going to give me 940. So I'll put 940 here, 940 here. This is the balance. Carry down, balance, brought down. And just like that, that's how you actually do cheapo's account, and it's done. And then we head on to here. This one says define the term depreciation and name one cause of depreciation. So how you define depreciation is like this. Depreciation is the loss of value of a fixed asset, or just any asset. If you want the loss of value of an asset, for instance, let's say depreciation is the loss of value of an asset. So depreciation is the loss of value of an asset. Yeah, I should have just written the loss of value of an asset over a period of time. Loss of value of an asset over a period of time. So now one cause of depreciation can be one cause of depreciation can be time factors. If you want, you can go for wear and tear. Yeah, any of that. So now we do with this one. So there's just something I actually wanted to tell you guys, is that every time I will be doing a lot of past papers for accounts, but when it comes for the errors, I guess this question for errors, actually, I guess it's actually easy, but I'm not actually that good with it. So you'll find that majority of the time I won't be solving them, due to the fact I'm actually not that well with the same errors, just to be completely honest with you. But the question that I will always be solving majority of the time, you'll be seeing me solving more of the control account, because on question 3 you have two options, either 3A or 3B. So you'll be seeing me solving more of the control account and the ratios. Yeah, but when it comes to the errors or the bank reconciliation statement, this I'm actually very sorry, but I'll be working on it. I guess for those maybe who would want tuitions, I can actually be helping out with that. Yeah, so let's solve B. Then for question 4, I'll actually make a separate video for it and then post it. So now let's go for question, this is 2B now. It says Elmson bought 4 machines on credit from Mazeva Equipment Ltd on 1st January 2010 for 20,000 each. He charged depreciation on the machine 20% per annum each year by reducing balance method. The policy is to charge a full year depreciation in the year of purchase, but not charge any depreciation, in the year of sale. 2 of the machines were sold for 13,000 each by cash on 1st October 2012. On the same date, 2 replacement machines costing 24,000 each were bought for cash. Sonder's financial year ends with 31st December 2012. Prepare the provision for depreciation account. So how I like to do this one, the provision for depreciation account, I'll prepare a table first. Prepare a table. One part to be called year. So I'll look at the machine that this person has. Sonder first had 4 machines. 4. Yeah. Let's see. Was there any other machine? Method. The full year depreciation review possible not. The machine was sold, cash, and send date to replacement. So he had 6 machines in total. So what is going to happen to my table is one, I'm going to say machine 1, machine 1, machine 2, so some says 3, 4, 5, and 6. In here are each total. My table majority of the time are normally small, but this one seems to be having like a lot of machines. So this is the way it's actually going to be. So in the first year, this person had 4 machines on credit from Amazon Ltd on 1st January 2010. Each machine costed him 20,000 each. So he charged depreciation of the machine 20% per annum using reducing balance method, not straight line method. So this is the way it's going to be. So for the first year, this was taking place in 2010. Having yet started solving the provision for depreciation, I just want to make this table. It will actually make the solving of the provision for depreciation much easier. So the first machine costed 20,000 times 20 over 100. We're finding depreciation for the first year. So this is going to be 20,000 times 20 divided by 100. This is going to be 4,000 for the first year. So meaning even for the other machines, since they all costed the same thing, yeah, so they're saying each costing 20,000. So meaning even these other machines, it's just going to be 4,000 for just the 4 machines. Sorry, 4,000. The other 2 have not yet been introduced. Since he bought them, 2 machines were sold by cash on 2012, and on the same day the other ones were actually bought in 2012. So the total depreciation for this one, for in 2010, we're going to add up this, the 4,000 for the first machine, for the second machine, for the third machine, and for the fourth machine, giving me 1,000 or 16,000. Then I'll head on to, I'll close this one simply because I'm done with it. Then I'll go on to 2011. So now for 2011, was there anything that took place? The annual each year using the policy was charge fee, depreciation, charge. For 2011, nothing big actually happened. So how we're going to find the depreciation for 2011, we're going to say 20,000 minus 4,000. So 20,000 minus 4,000, which is giving me 16,000 times 20 over 100. This is how reducing balance method works, and this is going to be 3,200. Then even for the rest, it's going to be 3,200, 3,200, 3,200. And add them up for all the machines. 3,200 plus 3,200 plus 3,200 is going to give me 12,800. I close it up. Then I head on to 2012, the last year. So in 2012, this is what was happening. Something happened in 2012. In the year of sale, sorry, let me start it from let's see. The policy is to charge a full year depreciation in the year of purchase, but not in the year of sale. 2 machines were sold for 13,000 each by cash on 31st October 2012. So 2 machines were sold, and they're saying that I shouldn't charge depreciation here. I shouldn't charge depreciation in the year of sale. So 2 machines have been sold in 2012. So I'll go for machine 1 and machine 2 that have been sold. But for these other ones, I'll charge depreciation since that's still existing. So what I'm going to do is actually this 16,000. 16,000. Or maybe I should have just said machine 3 and 4 have been sold out. Then I'll leave machine 1 and 1. So I'll say 16,000 minus 3,200. 16,000 minus 3,200, which is giving me 128. 12,800 times 20 over 100. So times 20 divided by 100, which is going to give us 256. So we'll charge depreciation for 2 machines only, but for the rest, for the other 2, we won't charge. Simply why? Because they've been sold. It's then saying him 2 of the machines were sold, 13,000 each on 1st October 2012. On the same date now, on the same date, 2 replacement machine costing 24,000 were bought. So now we've got another machine is costing 24,000. We're going to charge depreciation for this one simply because they've been bought. So 24,000 times 20 divided by 100, which is giving me 4,800. Even for the other one will be 4,800. Then I add up the total. We see how much we get as our total depreciation. So there's 2,560 plus 2,560 plus 4,800 plus 4,800, giving me 14720. And just like that, with the help of this table, it will actually help me prepare the provision for depreciation account. So we start preparing the provision for depreciation account. This is how the provision for depreciation account is actually going to be. So I start details, debit, credit, folio, debt. So the provision for depreciation account starts with profit and loss. So where do I get the same profit and loss? I'll get it from here. This is my profit and loss, 16,000. One that I had calculated, 16,000, and this was the one for in 2010. This was 1st January 2010. Then from there I'll say balance. And when this is balance carried down, this is balance brought down, and when here will be 16,000, and this is balance as well. This is for balance brought down, and this is going to be 1st of 2011. This should be the end, 31st 12 2010. Then here we'll have 31st 12 2010 2011. This will be profit and loss. And I've said the profit and loss, where am I getting them from? Because I was calculating as my total depreciation, 12,800. Then now balance. This is balance carried down. Balance carried down. So now what I'm going to do is 16,000 plus 12,800, which is giving me 28,800. 8,800. Then even here on the balance carried down, 28,800. Even 28,800. The one else here is actually balance brought down. Balance. And this one is for the 1st 2012. Then 31st 12 2012. The profit and loss. Then now keep in mind that in 2012 was actually something that took place, was that there was disposal. There was a disposal. The profit and loss, but for however for 2012 was what? 14,720. The disposal, how do you find the disposal? You go on to the two machines, the two machines that were disposed of. So when the two machines are these, there's no depreciation in these ones. This means, it means like these machines were disposed of, they've gone. Otherwise we're supposed to have a depreciation. So to find that, how I'm going to find the depreciation that I'll put in the profit and loss, I'll add up the depreciations that were used for, like for 2011 and 2010. So for the first machine that was sold, this one, there's 3,200, which is this, plus 4,000, plus the other machine, it had another 4,000 plus 3,200, giving me 14,400. That's the disposal. Disposal is always debited 14,400. Then we write balance. This is balance carried down. Then there will be a balance brought down. It's on the 1st, 2013. So this is going to be 28,800 plus 14,720. This is going to give me 43,520. 43,520 minus 14,400, which is giving me 29,120. 29,120. And just like that, that's how you deal with the provision for depreciation. So this should have been Msonda's provision for depreciation account. Yeah, and that's how it's actually truly supposed to be done. Okay, thank you very much for watching, guys. I'm actually going to make a separate video of me preparing the manufacturing account, because if I actually do it right now, then that means I'll have to extend the video way longer. So I'll cut it just here, then I'll do the provision for depreciation and actually also send the same video. I mean on the manufacturing account, sorry. Right, thank you very much, guys.